You know why 90% of traders lose money? It's simple, really. They're jumping in right when the smart money is getting out.
Take a look at this. That massive 60% rocket launch, that wasn't luck. No way. It was a footprint left behind by the big players.
And you know what? I'm going to show you exactly how to find these footprints for yourself. If you're ready to learn, do me a favor, hit that subscribe button right now, and let's get into it.
All right, forget everything you think you know about indicators. We're going way deeper. We're talking about the market's core code.
See, every single candle on your chart, it's all telling the story of one simple, powerful force, an imbalance.
Think about it. When there are way more buyers than sellers, what happens? Price has to go up. It's not a theory, it's a fundamental law of the market.
This is the big difference, right? Retail traders, we tend to chase moves. But the big institutions, they're setting traps. They need our orders, that's called liquidity, to fill their massive positions.
So you have to stop being the hunted. You've got to start thinking like the hunter. Seriously, this one single mental shift can literally change your entire trading career.
All right, so how do we do that? Let's pull back the curtain and learn to read the map just like the smart money does.
Looks simple, right? But how can one single line on a chart predict major market turning points with this kind of accuracy?
Okay, let's break this down. The trend kicks off right here at point A. Then look, at B, C, and D, price just bounces right off this line like a trampoline. That's active demand, happening right in front of your eyes.
But then, something changes. Right here, at point F, boom, the line breaks. The buyers couldn't hold it anymore.
And this is the magic part. That same line that was a floor, that was demand, has now flipped. It's become a ceiling. It's now powerful supply.
You see that? Once you see this pattern, you can't unsee it. This is how you stop guessing and start anticipating.
Okay, that's the theory. But does it work in the real world? Let's open up some case files on Apple and Tesla and see this code in action.
First up, Tesla. Check out this area down here where price just exploded upwards before. That's a clear demand zone. Now watch what happens as price comes back to test it. Not once, but twice.
That first touch, it led to a 23% explosion in just 2 days. Insane, right?
But it's not done. Price comes all the way back down to that exact same spot. The institutions, the big money, they stepped in and defended that level.
And the result of that second touch? A massive 60% run. That is the power we're talking about.
Are you starting to see how powerful this is? If this is clicking for you, do me a huge favor and just smash that like button and subscribe for more. And hey, it wasn't a one-off with Tesla. Look at Apple. Same exact story. A proven demand zone gets tested and boom, a quick and clean 14% gain. So the strategy itself is pretty simple, right? But here's the million-dollar question. Can you control your own emotions when real money is on the line?
You know what I'm talking about? Fear, hope, regret. That emotional roller coaster. That's what ruins more traders than any chart pattern ever will.
The solution? It's the set and forget strategy. You identify a quality zone, you place your trade, and then, the hardest part, you walk away. Forget the noise. This is how you build real discipline.
You have to let your trading plan be the pilot. Your emotions, they're just noisy passengers in the back. The calmer your mind is, the cleaner your execution is going to be. Period.
All right, we've talked about what happens when it works. But what about when it doesn't? Pay close attention, because this part is absolutely crucial. Let's look at Google here. You can see this demand zone. The first bounce off it is pretty strong, right? But the second bounce, it's a little weaker.
Then, the third bounce barely gets off the ground. The buyers are getting exhausted. And then, on that fourth touch, snap, the zone fails. It breaks.
But here's the thing you have to understand. A failed zone isn't just a loss. It's not the end of the story. It is a brand new signal.
And what that signal means, well, that's exactly what we're going to break down in the very next explainer. So make sure you're subscribed with notifications on, because you are not going to want to miss it.
Be careful. Most traders lose because they enter where smart money exits. Let me show you exactly where supply turns into selling and where demand ignites the next move. Here's my legal disclaimer, and here is a 14% move captured based on supply and demand strategy. I'll tell you what's the story behind this trade, and I'm gonna tell you how can you spot such trades on your own. Just hang on, click the subscribe button, and let's get started. What is supply and demand? Every price movement on a chart is caused by one simple force: the imbalance between supply and demand. When buyers outnumber sellers, price rises. When sellers overpower buyers, price falls. This isn't theory. It's how every financial market on earth operates, from forex to stocks to commodities. If you don't grasp this fundamental truth, nothing else matters. Supply and demand is the law beneath every candle. It's not an idea, it's the code. Most traders lose here, and they don't know why. Look closely. Every time price hits this upper line, it gets slapped down. That's not magic, that's supply. Smart money sells while everyone else is buying the top. And down here, this isn't luck, it's demand. Big buyers quietly load up while retail panics. The market isn't random. It's a battlefield of levels. If you can spot these zones before price reacts, you don't chase the moves. You predict them. Watch how price respects these lines again and again. Once you see it, you can't unsee it. Price moves on imbalance of orders. Markets do not move randomly. They move when large orders flood the system. Picture thousands of buy orders stacked at one price point, but no one willing to sell. Price explodes upwards to find sellers. This is imbalance, and it's where big moves begin. These imbalances from the core of the strategy. These imbalances from the core of the strategy. The precise zones where smart money placed unfinished business. If you can spot them early, you don't follow the move, you lead it. Institutional versus retail behavior. Retail traders chase price. Institutions don't. They plan their entries where others panic. They need liquidity, and you provide it when you enter too late. Institutions set traps, not signals. As a supply and demand trader, your job is to think like them, not follow the crowd. Learn where they place their buy orders before price takes off. Stop being the hunted. Start thinking like the hunter. That's the shift that changes everything. How one line predicts every major move on this chart. Have you ever wondered what is this line and how we can draw one, how we can spot them? Watch this, because this chart hides one of the most powerful secrets in trading. Look at point A here. Here's point A. That's where the trend began. Then B, C, D. B, C, D. Price keeps bouncing off the same rising line like it's magnetized. That's not luck. That's demand. But the real shock comes later. See point F here. Price finally breaks the line. And suddenly, that same support becomes supply at G and H. Here is G and here is H. We have the same line which was serving as demand. Here, after this break, this same line is becoming a supply line. One flip and the entire market behavior changes. If you can spot these transitions early, you stop guessing trends and start predicting reversals before they happen. The sit and forget strategy. Trading does not have to consume your life. Once a high quality zone is identified, the trade is placed and left alone. No watching every candle, no second guessing. This is sit and forget. It builds emotional discipline by removing your need to control the outcome. Price does work. You stay calm. The goal is consistency, not chaos. Watch this with this mindset. Trading becomes less about a reaction and more about precision. Place the trade, forget the noise. And I can go back to the previous slide. The last sentence clearly showing visible on this line. Now here comes the patience part. Mastery requires time. This isn't fast road. It's a long path walked by few who commit. Supply and demand isn't a strategy you try. It's a mindset you build. That takes months, even years. You must train your eyes to see zones instantly. You must reprogram your instincts, but they reward clarity, confidence, consistency. If you are willing to stay when others quit, this method will give you something most traders never get, an actual edge. Here's another chart that I will discuss with you later. Plus 60% move in profit Tesla brought in April 2025, all used by demand and support strategy, trading strategy. The emotional curve. Every trade pulls you into an emotional story. Fear, hope, excitement, regret. That roller coaster ruins more traders than any chart pattern ever will. But emotions aren't the enemy. Unmanaged emotions are. Your goal is to turn chaos into structure. Let your trading plan be the pilot. Your emotions are just passengers. The better you manage your inner state, the sharper your decisions, the calmer the mind, the cleaner the execution. How one line predicts every major move on this chart. Again, we're going to cover the second line here. Watch this closely, because this is where the entire trend reversal, its true face. Look at P, Q, and R. Here, each bounce is weaker than the last. That's distribution. Smart money unloading while everyone else thinks it's just a pullback. Then we reach O. Here, the final push into the supply line. Here is the demand line. After it broke here, it becomes a supply line, a dangerous line. that you don't want to enter a stock when it comes near. The final push into the supply line, price taps it, hesitates, and cracks. The moment that supply line breaks, everything flips. Buyers disappear, sellers rush in, and the chart collapses. This isn't random. It's how big players exit quietly before the drop. Once you spot it, you will never chase the top again. The Holy Grail myth. Is there a Holy Grail in trading? Let's see. There is no Holy Grail in trading. No system that wins every time. No indicator that solves everything. Chasing perfection is a trap, and it ruins most traders. What works in this? A repeatable edge, risk control, and emotional strength. Supply and demand gives you an edge, but you must commit to it fully. Tweak less, focus more, because mastery does not come from finding the best system. It comes from becoming the best executor of one. Confirmation candle logic. One of the most crucial filters in supply and demand trading is the confirmational candle. The candle that breaks out from the base or structure and confirms directional intent. Without confirmation, many zones remain theoretical. Confirmation candles are not merely large in size, they also appear at the right location. Fresh zone, curve edge, or reaction area, and with volume support. Think of them as the verdict candle. The market has spoken. Understanding confirmation candle logic filters out 60 and 70% of false trades. It adds confidence, timing precision, and context to zone selection. Always wait for the market to show its hand. How to draw supply and demand zone. To draw supply and demand zones correctly, look for areas where price made a strong and fast move, either a rally from a base, demand, or a drop from a base, supply. Start from the last candle before the strong move. For supply zones, draw from the top wick of the base candle to the top of the highest wick before the drop. For demand zones, draw from the bottom wick of the base candle to the lowest wick before the rally. The base should be small and tight, ideally 1 to 3 candles with small bodies. Avoid drawing zones from choppy or consolidating areas. Precision is the key for valid entries. Identifying the base, supply-demand zone formation. Before a significant price movement, the market often consolidates briefly. This zone of the tight price action is referred to as the base. It typically features small-bodied candles, as we can see here, prominent wicks suggesting order absorption, the lower wicks here, low volatility and narrow ranges. We see here low volatility and narrow ranges. Confirming the departure. Validating of the zone. A supply or demand zone is confirmed when the price sharply exits the base with large-bodied candles indicating strong momentum, a visible break in market structure, elevated trading volume as we can see here, clear imbalance or fair value gap. The sharper, more decisive this departure is, the more reliable the zone is considered. And here's another important chart and very important aspect to grasp in supply and demand trading strategy. Supply might become demand. Let me show you something the market never teaches beginners, but it controls everything you see on this chart. Look from 2001, here 2001, price keeps bouncing off the same horizontal levels. These aren't random lines, they are demand zones, where buyers quietly step in. Every small circle you see, near 20 and 30, here and here, that's demand holding the floor, refusing to let price fall. Move into 2003, here, demand pushes the trend upward. Then suddenly the first major supply zone shows up around 40, here. We can see here the stock hit the 40, which was a supply zone, then it retraced a bit, then came back again. Watch how price taps that line and snaps back down here. That's not noise, that's real sellers unloading positions. 2004 to 2006, this area. The market climbs, but every time price hits the 60 level, supply wakes up here. Sellers defend that zone like a fortress. Then in 2007, price reaches the big one, the 80 supply level, here, as we can see. Look at point A here. A clean rejection. Price tries again, fails. Here's the first try, it pulled back. Here's the second try, but it was very harsh drop after that. And again fails. Each circled rejection is supply crushing momentum. This is distribution in plain sight. Now watch what happens during the 2008 crash. Here, price collapse through 80, slices through 60, and free falls all the way back to the old 40 demand zone. It's here. And guess what? It holds, as we can see here. It held here and it held here. The same buyers who defended 40 in 2004 here defended again in 2008. Demand does not forget. Then the recovery begins. And here is the shocking part. Old supply becomes the new demand. Price breaks above 60. And we can see here this 60, which used to be supply, now it serves as a demand. Price breaks above 60, and instead of rejecting it, it bounces upward from it. Textbook demand shift. The same happens at 80. Once supply, now demand. Check this out. In 2006 and 2007, it was harsh supply line. Now it's becoming a demand line after its break above the 80. Finally, 2011 and 2012, price launches into the 100 here. Look closely at those bounces. Each tiny rejection is fading supply. Sellers are getting weaker. Demand takes full control, launching price into new highs. These bounces, they tell the entire story of who controls the market. Once you learn to read them, you stop reacting to candles and start reading the intentions behind them. Trend lines. Take a look at this chart. Something subtle is happening here. Notice how every bounces gets rejected at the exact same diagonal line. That's not magic, that's a trend line. And yes, it works just like supply. Each time price hits it, sellers step in stronger until eventually the entire trend breaks down. But here's the twist. Here's the break. This simple line can predict reversals weeks before they happen. And we're barely scratching the surface. I'll explain why trend lines act as a dynamic supply in an upcoming video. So stay tuned, click the subscribe button so you never miss my great content. Follow the channel and you don't want to miss the serious stories. How to draw them. If you have ever wondered how traders spot the exact zones where price reverses, this is it. Start with the obvious. Look for areas where price reacts multiple times. For supply, find the zone where every rally gets rejected. This area. That's where sellers hide. Draw a box around the cluster of wicks, not the bodies. For demand, do the opposite. Locate where every drop suddenly stops and buyer steps in. Here, here, and here. Again, box of wicks, mark the range, and extend it forward. These zones are not magic. They are footprints of big money. Learn to spot them, and you will never chase price again. Which pattern? Watch this pattern carefully, because it reveals how smart money trades. Price rallies into supply zones and gets slammed down. Sellers are waiting. It drops, hunts for a demand, and buyers steps in. Same principles over and over. I'm trying to tell you guys, because probably some of you missed the first slide, or probably he didn't watch and listen carefully. So that's why I'm saying it again. The same principle. Watch for the supply, draw a line. Watch for the demand, draw a line, and here are your trading zones between those levels. Rally and base. Look closely at this chart, because this is how real demand forms. First, we get a strong rally. Fast, confident buying pressure. Then prices pauses, creates a tight base here. That's where big money stacks orders. No noise, no drama, just quiet accumulation. And when the base is filled, Boom. Another rally launched straight out of the zone. This is the classic rally-based rally pattern. Every time price returns to that base, buyers defend it. Here, as we can see, buyers defend it like a fortress. Once you learn to spot these zones, you stop chasing candles and start trading where the real power sits. Here's another example. This is what a clean demand to supply move looks like. Price taps the lower demand zone, rejects hard, then launches into a powerful rally. Notice how every candle builds the momentum. Buyers are in full control. The stop sits safely below demand, and the reward opens all the way up towards supply. Once price enters the upper zone, everything slows down here, here, and here, as if the market hits an invincible ceiling. That hesitation, that's institutional selling. Your job isn't to predict, it's to follow the footprints. Demand gives you the entry, supply gives the exit. Master these zones and trading becomes shockingly simple. And make sure to subscribe to the channel. Now, the 14% move in Apple, what's the story behind it? Here's a real chart for Apple stock. Just like the previous, all of the charts that I've explained and explore in my slides are all brought from real trading stocks or commodities. So nothing here is AI generated. No, everything you see here, you can go back to the Apple stock, go back to the 2022 November, and you will find the same chart here. Same chart. So what's the story behind Apple? And can demand and supply trading strategy apply to Apple? Let's see now. Look at this Apple chart and notice something subtle, but extremely powerful. Every time price drops into the lower demand zone here, buyers step in aggressively. You see it here, a clean bounce, strong candles, and then fast 14% move upward. That's not random. That's not random. It's supply and demand strategy. That is demand doing its job. Institutions accumulating when retail is fearful, and the chart leaves their footprints behind. Now, look again at how price returned to this level another time here. Same reaction. This is institutional moves, and this is again price goes back, same demand, same opportunity. When a zone produces a repeated strong bounce, you're not guessing, you're trading a proven reaction level. This is where the profit lock strategy shines. Instead of holding blindly, you use the demand zone as your confirmation. Once price leaves the zone and breaks above minor structure, you lock in partial profits and trail the rest into strength. The goal isn't to predict the top. It's to protect gains while letting the trend pay you. Demand provides the entry. Momentum provides the follow through. The previous supply or moving averages often act as your logical take profit zones. This is how professional trade Apple and any. This is how professionals trade Apple and any stock, not with hope, but with zones, structure, and controlled profit locking. Tesla, the 60% move, April 2025. You go back to the chart, you're going to find the same moves for stock Tesla here. And again and again and again, supply here, demand. Look at what Tesla did here, because this is a perfect example of why supply and demand trading is so powerful. First, price taps the demand zone, not once, but multiple times. Each touch shows buyers stepping in with conviction, and then it happens. The first move, 23% in 2 days here. That's not luck, that's demand doing exactly what it's supposed to do. Launch price fast before most traders even react. But the real magic comes next. After consolidating and holding higher lows, price returns to the same area, same demand here. And once again, institutions defended it. This is the time the move isn't small, it's massive. A 60% run over 37 days, as we can see here. Controlled, steady, relentless. This is what happens when a true demand zone holds. The market shifts from fear to accumulation, and the chart explodes upward. The strategy is simple. Identify where buyers are hiding, wait for a price to confirm, and trade with the big money, not against it. Supply zones give you exits. Supply. Demand zones give you entries. Demand. Tesla didn't just bounce. It launched twice from the same footprint. And that's why this method is one of the strongest and timeless in trading. Let's come to the last chart of this lesson. Make sure to follow my YouTube channel for more great content and stick the video. The video hasn't finished yet, because here's a new and important lesson in this chart. More than a trade. Google, July 2000 or 2022. Erodes slowly. Look at these reactions. Look at these 3 reactions, because they tell you everything about how a demand zone slowly weakens before it finally breaks. First bounce, strong and clean. 10% buyers step in with confidence. Second bounce, here's the first bounce, here's second bounce also. Here's the first test and first base for building a demand zone here. Second bounce, still powerful, still double digit, but slightly weaker. Third bounce here, it works again, but notice how the move struggles as it approaches the moving averages here. That's your first warning. When demand starts producing smaller bounce, it means buyers are losing strength, while sellers are building pressure above. And then it happens again. The fourth touch here. Price taps that level, hesitates, and instead of launching upwards, it rolls over. This is the classic failure. Demand does not break suddenly. It erodes slowly. then snaps all at a time. When you see a failed bounce like this, very important, you don't hold the hope, you don't hold and hope, you switch mindset immediately. Demand is no longer your entry, it's now your risk. So how do you set a profit target? Simple. Every bounce from a demand should aim towards the nearest supply. It could be a moving average, it could be previous swing high, or volume clusters. Those are your take profit zones. You're not trying to catch the top, you're harvesting the reaction. Demand gives the entry, structure gives the exit. That's how you trade these bounces with confidence. Thank you very much. Hopefully, I taught you something great. Make sure to follow my YouTube channel, support my channel, and I'll do my best to help you, my fellow traders. Thank you, and bye bye. Average crossover strategy is one of the simplest mechanical trading system. It uses two moving averages, a fast one and a slow one. The fast moving average reacts quickly to price changes and hugs the price. The slow moving average is smoother and lags behind the price action. A basic rule: when the fast MA crosses above the slow MA, it generates a bullish signal. When the fast crosses below the slow MA, it generates a bearish signal. These signals can be converted into clear instructions to buy, sell, or exit trades. In this chart, we see a synthetic price series moving generally upward. The fast 10 period MA turns faster and changes direction more often. The slow 30 period MA is smoother and shows the underlying trend. A crossover system tries to catch big trends and ignore small market noise. The main advantage is that the rules are objective and can be programmed. The main disadvantage is that the moving averages always lag price. This lag means entries and exit will never be at exact tops or bottoms. In strong trends, this lag is acceptable and the system can make large gains. In sideways markets, the same system can produce many small losing trades. Throughout this document, we will turn this simple idea into a full framework. We will study entries, exits, risk, fake signals, and detailed statistics. The goal is to see if the MA cross can be serious, testable trading strategy for you. In strong trend, the moving average cross strategy is one of the simplest mechanical trading system in technical analysis. It uses two moving average, a fast one that reacts quickly to the price and slow one that moves more smoothly. In this chart, we create a synthetic price series that trends slowly upward with random noise. The blue line represents the closing price of our artificial instrument. The dashed line labeled Fast MA 10 is the average of the last 10 closing prices. The dashed line labeled Slow MA 30 is the average of the last 30 closing prices. Notice that the fast moving average stays closer to the actual price and reacts faster to changes. The slow one is smoother and lags behind the price more clearly. A typical MA cross system would buy when the fast crosses the slow one. The same system would close the long trade or go short when the fast one closes or crosses below the slow one. This simple rule turns a chaotic price chart into clear mechanical if-then decisions. The main advantage is that the rules are objective and can be backtested on historical prices. The main disadvantage is that moving averages lag the price and often react late. In strong trends, the MA cross method can capture big swings and ignore small noise. In choppy sideways markets, the same rules can lead to many losing trades and whipsaws. Understanding both sides, strength in trends, weakness in ranges, is essential for using MA crosses safely. Throughout this project, we will extend the symbol idea into a complete testable trading framework. We will study not only the entries, but also stops, targets, fake signals, and overall performance. Now let's move on to the third slide. Before we trade any strategy, we need to generate and handle price data. Here we are create synthetic price data with two regimens, an uptrend and then a mild downtrend. In the first half, the drift is positive, so prices tend to move higher. In the second half, the drift is slightly negative, so the market rolls over. This gives us simple trend then trend reversal scenario to test MA behavior. On top of the price, we calculate 3 moves averages, 10, 20, and 50 periods. The 10 reacts quickly and sticks close to the price. The 20 is medium speed and smooths out more of the noise. The 50 MA is slow and highlights long-term directions only. As the market turns from bullish to bearish, the fast MAs cross the slower one. These crossing are the raw material for MA crossover entry and exit rules. Longer MAs can help you avoid some whipsaws, but will also enter later. Shorter MAs will get you in and out faster, but may generate many false signals. Understanding this trade-off between speed and stability is key. In practice, we can test many different MAs lengths and pick those that behave best. Later, we will use the same data to build trades and performance statistics. The fourth slide. In this page, we highlight how actual trade signals appear on the chart. We use a fast, let me zoom out this picture to make it clearer for you guys. We use 10 period MA and slow 30 period MA on a trending price series. When the fast one moves above the slow one, it makes a bullish cross and a bearish cross on vice versa. Each bullish cross could be seen as signal to exit longs or even enter short. These cross points represents the core logic of a basic MA crossover strategy. Notice that cross do not occur at the exact bottom or at the top of the move. The system enters once a trend is already underway and exits after some reversal. This is the classic profile of a trend following system. Late in, late out, but catching the middle. When the market is in a clear trend, signals tend to be spaced out and directional. When the market is noisy, you will see the MAs crossing more frequently and chaotically. Each cross is a mechanical decision with no need for subjective judgment. This objectivity is what allows us to code and backtest the system precisely. In later pages, we will convert these crosses into a list of trades with entry and exit prices. From that trade list, we will calculate average profit per trade, win rate, and more. Understanding how these arrows appear is the first step to understanding the statistics. Next slide. Different trades use different MA lengths for their crossover strategies. Short combinations like 5 to 20 react quickly and generate more signals. Longer combinations like 20-50 move slowly and generate fewer trades. In this chart, we plot both a short-term pair 5 and 10 and the long-term 20 and 50. The short pair hugs the price more tightly and changes direction frequently. The long pair is smoother and sometimes barely turns when the price wiggles. Short MAs help you catch turns earlier, but also expose you to move whipsaws. Long MAs filter more noise, but may miss parts of the move and give late entries. There is no universal best MA length. It depends on the market and time frame. We can only judge MA length by backtesting on historical data. Shorter pairs might suit intraday or swing trading on a volatile instrument. Longer pairs might suit positions trading or higher time frame trend following. In this project, we will use common pairs like 10 and 30 as examples, but the idea is general. The key is to understand the trade-off between speed and stability in MA design. Later, you can use the same code pattern to test your own custom MA links. Let's move on to the next slide. All right, whipsaws in sideways markets. When you try to trend follow in a range, frustration is guaranteed. We can reduce the whipsaws by using filters that confirm the presence of a trend. For example, we may require that price is also above higher time frame MA or key support resistance break. We can also reduce position size or skip trades when volatility is extremely low. Later, our backtests will show how much damage whipsaws do and how filters can help. Fake signals, traps around MAs. Another defense, not every move through a moving average represents a true change in trend. In real markets, price often dips below a key MA and then quickly recovers. These moves are called shakeouts, stop hunts, or fake breaks. In this synthetic example, we model an overall uptrend with occasional violent drops. These drops push price below the MAs briefly and then snap back up. A naive MA cross trader might interpret each break as a trend reversal. They exit longs or even go short only to see the price reverse and continue higher. This creates emotional pain and the feeling of being tricked by the market. Large players sometimes use areas near popular MAs as liquidity zones. Retail stops cluster around these levels, providing fuel for the fast reversals. One way to defend against fake signals is to require confirmation after a cross. For example, we might wait for 2 or 3 closes on the new side of the MA before acting. Another defense is to combine MA signals with structure, such as higher's high and higher's low. If prices briefly dips below the MA but does not break a key swing low, it may still be an uptrend. We can also look at volume. If a move through the MA happens on low volume, it may be less reliable. Later backtesting will show how much confirmation reduce fake signals and how many good trades it delays. Our task is not to eliminate all fake signals but to keep their costs under control. Next slide is from crossovers to equity curve, visual trade results. Let me zoom this out for you guys. Zoom this in, sorry. The shape in this page, we convert MA crossover signals into real money management, shown as an equity curve. The blue line shows the synthetic price of our test instrument over time. We use a 10-period fast MA and 30-period slow MA to generate long-only signals. Green triangles mark the entry points when the fast MA crosses above the slow. Red triangles mark the exit points when the fast MA crosses back below the slow MA. For simplicity, each trade uses a fixed 1-unit position size. The profit or loss of each trade is the difference between exit price and entry price. We store these results in a trade list and then compute running sum of P&L. The purple equity curve on the secondary axis shows the cumulative P&L over time. When the equity curve rises, the system is making money. When it fails, it is losing. Notice how some long trends produce multiple steps up in the equity curve. Sideways and choppy periods can flatten or drag down the equity curve. The shape of the equity curves tells us about the character of the strategy. A smooth rising curve suggests stable performance. A jagged or flat curve suggests stress. This chart replaces raw printouts with a visual story of how the MA cross performs over a sample. Later pages will focus on the distribution of trade results and the impact of exit and targets. Let's move on to the next page now. Distribution of trade returns, average profits per trade visualized. Here we move from the equity curve to the distribution of individual trade results. Each bar in the histogram shows how many trades fall into given percentage return bucket. Trades on the right side of 0 are winners. Trades on the left sides are losers. The dashed vertical line mark the average return per trade in percentage terms. If that average is clearly to the right of 0, the system has a positive edge. If it sits near or left of the 0, the MA cross strategy is not profitable before costs. In many trend-following systems, we expect numerous small losers and fewer large winners. So the small losers exists in all trading strategy. On the histogram, this appears as a cluster of small negative bars and a tail of larger positive bars. The width of the distribution reflects how volatile the trade outcomes are. Wide distributions with fat tails indicate that some trades are very large winners or losers. A narrow distribution means most trades cluster around a small gain or loss. This histogram helps us to feel the psychological reality of trading this system. For example, if many trades lose between 1 and 2%, can you emotionally handle that sequence? That's a very important question. If winners are 5% or 10%, but rare, you must be patient enough to wait for them. This visual also supports comparisons. We can later draw the same histogram for filtered strategies. A better strategies will ideally shift the distribution to the right and cut off some of the extreme losses. Next slide, comparing profits, targets visually, R multiplies. In this page, we test how different profit targets change the behavior of our MA crossover system. We define risks as a fixed 2% below entry and the test targets at 1R, 1.5R, 2 and 3R. Each bar in the first chart shows the average P&L per trade for a given R target. If a bar is higher, that R target produced more profit per trade on average. The second chart excuse me, typically smaller targets like 1R are hit more often, as we can see on the chart, giving a higher win rate. Larger targets like 3Rs being hit less frequently, causing a lower win rate. A trader who hates losing streaks might feel safer with a high win rate 1 target. A trader who is comfortable with long flat periods might choose higher R for bigger payoff. The best safe target is not always the one with the maximum average PNL. Sometimes a slightly lower average PNL with a higher win rate is easier to stick with emotionally. These bar charts transform abstract discussions about exits into clear visual trade-offs. You can quickly see which R levels are weak, average, or strong for this data sample. Later, you can repeat the same experiment with different MA pairs or filters and compare the bars. This is how we build data-driven exit plan, not a random one. The next slide is ATR illustrated volatility and dynamic risk. Here we visualize volatility using the average true range, ATR, alongside price. The blue lines shows the close price of our synthetic instrument. The dashed line on the secondary axis shows ATR 14, the 14 period of true range. The true range measures how far price can move in a day, including gaps. When ATR rises, the market is more volatile. Candles are larger and swings are wider. When ATR falls, the market is quieter and daily moves are smaller. Many trades base their stop losses on a multiple of ATR below entry price. For example, a stop at 2 ATR under the low of the entry bar is common in trend systems. This makes stop adaptive. In calm conditions, stop are tighter. In wild conditions, they are wider. Adaptive stops interact naturally with MA cross entries, which often appear during volatility changes. By looking at this chart, you can see periods when price trends up while ATR stay moderate. Those are often good times for MA cross strategies, as trending noise is manageable. When ATR spikes without clear price directions, markets may be harder to trade with simple MA rules. Later, you can combine ATR-based stops with MA entries and rerun the equity curve and histogram. That will show whether dynamic volatility-based risk management makes the MA cross more safe and robust. Thank you. We have come to the end of part 1. I'll continue making the other parts as well in the following video. Thank you very much.